welcome to all the participants of today's program. We have with us today to present on topic TDS under Section 195, Form 15CA and Forms 15CB. Kotha sir with us, who was past chairman of SIRC of ICI. We also have with us Geeta madam as moderator for today's program, who is SIRC committee member. Hearty welcome to you, sir. Hearty welcome to you, ma'am.
Thank you. Thank you.
Now I request Geeta ma'am to kindly address all of us.
Secretary of Bangalore Branch CA Divya and all other team members of Bangalore Branch. Speaker of today's program, CA Cotha S Srinivas sir. My dear viewers, happy evening to all of you. So we are all aware that tax has to be deducted before making any payment to non-resident under Section 195. And so compliance under Section 195 is not only an opportunity for chartered accountants, but also it helps the government in collecting due taxes and providing the assessee the right to know liability of TDS payable on the transaction entered. So more so in the current situation, we are receiving flats from clients whose foreign remittances has been stuck as the website is not working properly and we are not able to issue certificates under Form 15CB, which is required for foreign remittances as a link is not opening. So in this situation, it is very important to know more about the intricacies in the provisions of TDS relating to non-residents and rules, regulations, procedures for submitting the forms to comply with the requirements. It is very much the need of the hour, and we are sure that today's session will enlighten us about the provisions and issues under Section 195 and Form 15CA and 15CB. With this, now I'll hand over the session to Divya for a brief introduction of our speaker. Over to Divya.
Thank you, ma'am. Dear all, it's my pleasure indeed to welcome our past SIRC chairman as today's speaker, who is none other than Kotha S Srinivas. He is a BCom graduate from Bangalore University and a fellow member of ICI also. He is a member of Institute of Cost and Works Accountants of India. He is also partner of SSB and Associates Chartered Accountants, Bangalore. He has served Institute for over last 2 decades, 2.5 years as student committee member of CA Cotha in Bangalore branch, 9 years as managing committee of Bangalore branch of SIRC of ICI, 9 years as regional council member of SIRC of ICI. He was also SIRC chairman a couple of years ago. With this very, very brief introduction, I wholeheartedly welcome to you for today's program, sir. Hearty welcome to you, sir. Over to you.
Chairman is there. If he wants to say a few words.
Yeah, hello. I
Chairman,
joined.
sir.
Sorry, I am out of station here. The network is very, very low. I am not able to on the video. So,
No
it's okay,
hearty
sir.
welcome to today's speaker, our past chairman, SIRC,
Thank you.
Cotha S Srinivas. I'm sure he will do one of the best session. It is already he has done several times TDS, so it is most sought after session. Thank you very much for Kotha S Srinivas for taking this session, and this is I think is most required one for the many of members, and I think our this income tax portal also is getting ready. So thank you very much accepting and delivering this lecture. So once again, hearty welcome to you. Over to Mr. Kotha S
Thank you.
Srinivas.
Thank you, Chairman. Thank you, Chairman. Thank you, Divya, the Secretary of Bangalore branch, and also Geeta, who is a member of SIRC.
Yeah, just a minute. Thank you for SIRC member, our Geeta madam, to take it up because she called me. In fact, I couldn't join because there is a shortage of power also here and network also is very, very low. Thank you, ma'am. Thank you for taking up this. Thank you very much once again.
Yeah, thank you. Now, let me share this presentation. Yeah, presentation is visible? Hello? Hello?
Sir, it's visible. Sir, it's visible.
Yes, sir, visible.
Okay, okay. So, good evening, members. Once again, I thank the Bangalore branch and also more so the chairman, BP Shetty sir, for giving me one more opportunity to share few of my thoughts with each and every one of you. In fact, Section 195, Form 15 CA and CP, I think in the month of June we discussed when we had a 1 week program on international taxation, a workshop on international taxation. At that time also this portal was not working, and I have to say that now also it is not working. So the portal still it is not working. So it subject to that portal working, other things whatever is there, let us discuss. I think most of you wouldn't have attended that international tax workshop. So if you have attended that, there may be certain repetitions. Otherwise, for those who have not attended that, it will be a fresh presentation as such. So what is that we are going to discuss today? So today I'll be discussing for maybe I'll be spending around 1 hour, 30 minutes or 40 minutes as such. Then we can leave for question and answers. So the introduction, then I will take you through the stages of TDS and comparison between resident TDS and non-resident TDS. Then I will take you through general aspects of Section 195. While covering this general aspects of Section 195, almost I would have covered Section 195 in overview of Section 195 I would have covered. Then Form 15 CA and CP we will see how what is the procedures that needs to be followed in the new IT portal. And if time permits, we will take issues and probable solutions. Coming to introduction, of course, all of us are aware of this tax deduction, so it's not a new chapter as such. I'll quickly run through this introduction. What I talk in the introduction is tax deduction. So there are 4 words as such. First word is tax, defined under Section 2, subsection 43 of the Income Tax Act. Tax means income chargeable under the provisions of this Act. This Act means Income Tax Act 1961. If you see Section 2, Section 43, the definition will be 4 to 5 lines. But the sum and substance of that particular definition is any tax. Tax means income tax chargeable under the provisions of Income Tax Act. Then we have the next word, deduction, not defined under the Income Tax Act. The general definition of deduction is the act of taking away something, an amount of money from a total. So whenever you're making a payment, a total sum, out of that, if you withheld something or withhold something and the balance you give it, that the act of withholding or taking away something is called as deduction. Then the next word is, the next 2 words is at source. What do we understand by at source? Even this is not been defined under the Income Tax Act. So the general meaning of at source means at the point of origin or issue. So we have to see the point of origin. In Kannada, if you want to say, we will say origin means moola. Like we will say, Kannadadalli ಹೇಳ್ತೀವಿ ಕೃಷಿ ಮೂಲ ನದಿ ಮೂಲ ಹುಡ್ಕಕ್ಕೆ ಹೋಗಬಾರದು ಅಂತ. So the moola, that is the point of origin, is what it refers to at source. When it comes to Income Tax Act or under the accounting, what do we understand by at source? What do we connect to at source? At source means the point of transaction. So we know the books of accounts is recording of the events of a business or recording of transactions. At source means the point at which you are recording a transaction in the books of accounts. So that is at source. So tax deduction at source means we are deducting tax at the point of recording of a transaction in the books of accounts. What type of transaction? We will come to that later. So at source means whenever an entry is passed in the books of accounts, that will be considered as a at source. That is a moola, that is point of origin. So the concept of TDS, there are 2 persons. One is the person called as the deductor. The person who is making a payment is called as a deductor, and the person on whom the amount is paid or deducted is called as a deductee. So on behalf of the deductee, the deductor deducts certain amount in the form of tax and remits that to the government in his name, that is in his PAN number as such. Now, moving on to section 4. Section 4 we know is a charging section which says it gives power to the act to charge any person or every person who earns income in a previous year to charge that particular income under the tax provisions in the assessment year. So the Central Act enacts that income tax shall be charged for any assessment year with respect to every person. So every person includes, like person is defined in section 2, subsection 31. Each and every person who earns income in a previous year in respect to the total income of the previous year. So whatever the person earns in a previous year, he will be subject to taxation in the assessment year. That is the power given in the charging section, that is section 4, subsection 1. Now 4 subsection 1 gives a power to charge the income tax. Then 4 subsection 2 says how to collect or recover this particular tax. So collection and recovery of tax. Under 4 subsection 2, there are two main sources of collection and recovery of tax. One is deducted at source and second one is paid in advance. So deducted at source means the tax deduction that we that the provisions which we are aware and which we are going to see under section 195. So the process of tax deduction at source or the tax collection at source, and the second one is paid in advance, that is advance tax payment. So to deal with these provisions, that is collection and recovery of taxes, we have a separate chapter in the Income Tax Act called Chapter 17. So if you see the structure of Chapter 17, we have various heads and it starts from section 190 and it runs through up to 234H. So first it is a general provisions, then Chapter 17B deals with deduction at source, then collection at source, advance tax, then other procedures, then interest chargeable in certain cases, then levy of fee in certain cases. So all these sections will be covered under Chapter 17 from section 190 to 234H. So whenever we talk about TDS provisions, we are aware that we refer to Chapter 17B. So it is Chapter 17 heading B, which deals with deduction at source. So section 192 to 206AB deals with TDS provisions. Almost 38 deductions are there in this particular heading as such. Today we are dealing with only one section, that is section 195. What is section 190? That is the general provisions of TDS, a particular chapter, deduction at source and advance payment. So section 4, when we were discussing, I said the Act has got a power to charge every person who earns income in a previous year to tax him to charge in the assessment year. We know that any person who earns income in a previous year will be subject to tax in the assessment year. But in reality, the taxes will not be collected in the assessment year. It will be collected in the previous year itself. So majority of the taxes will be collected in the previous year itself. So if you see how it will be collected through tax deduction at source, tax collection at source, and payment of advance tax. So we know, like any person who is having a tax liability of beyond 10,000 rupees, then he has to pay advance tax. So we know the installments, that is June, September, December, and March. By March 15, whatever is total estimated income, on that total estimated income, what is the total estimated tax? That tax has to be 100% has to be paid in the previous year itself. So if you analyze this, even though the income of a previous year is charged to tax in the assessment year, but the actual tax on the income earned in the previous year will be paid or collected in the previous year itself through all these sources. Then section 191 talks about direct payment. So when we talk about direct payment, so there are two situations, like a person who earns an income, for which TDS provisions is not applicable. So there may be a person who is having an income, on that particular income, TDS provisions is not applicable. Or there may be a second situation where a person earns an income on which TDS is applicable, but the person who is supposed to deduct TDS has not deducted TDS. So there are two situations: income in respect of which tax is not required to be deducted at source, and income in respect of which tax is liable to be deducted but not deducted. In these two situations, the person who earns the income has to make a direct payment. How we will make this direct payment? In the form of advance tax. What I was telling about the installments, through installments, he has to discharge his tax liability. So, assessee who earns an income and says that it is subject to TDS, but the person who is supposed to deduct TDS, he has not deducted. So there is no liability on my part. If the assessee says the department will not keep quiet, so they can proceed against the person who has actually earned the income and they can recover the taxes. Now let us move on to the stages of TDS and comparison between resident TDS payments and non-resident TDS payments. So there are 4 stages under TDS. One is D, next one is P, next one is R, and the last one is C. So when I say DPRC, these are all the 4 stages of TDS. By this time, you would have understood what I mentioned about D, that is deduction. Then the second stage is payment. Third stage is returns. The fourth stage is certificate. So first, the person deductor has to deduct the TDS. Then he has to make the payments of that particular amount, what he has deducted. Then he has to file the returns, then issue a certificate. Let us see how it has to be done, when it has to be done. So the date of deduction. What is the date of deduction? I was talking about at source. That is the date of entering a transaction in the books of accounts. So it says credit or payment, whichever is earlier. So if you are entering a transaction as a credit entry, the TDS will be there, or directly you are entering a payment entry, that also there will be a TDS. So the date of deduction will be the date of making an entry, either as credit or payment, whichever is earlier. So like if you see even in resident TDS payments, most of the sections deals with this, that is credit or payment, whichever is earlier. There are few sections under resident payments where it is not on credit or payment basis, but it is on payment basis. Similarly, even in the section 195, that is payment made to a non-resident, there are few circumstances where it will not be on credit or payment, whichever is earlier. It will be only on payment basis. That we will see later. Then payment. What is the mode of payment? How you will make this payment? So now, as of now, most of the payments we do electronically. Electronic payment in challan number 281. Maybe 15-20 years back, we used to have a physical payments. That is, we should have a challan, 4 sets of challans. We used to be there. We used to fill that, give it to the bank, and then collect two challans from that. All those things, physical payment was there earlier. Maybe from past 8 to 10 years, this electronic payment has come, and now most of the tax payments will be done electronically using challan number 281. Due dates. What are the due dates for making the payment? We know that the deduction has to be done at the time of our source, that is at the time of entering a transaction. After deducting, we have to make the payment. And what is the due dates? When it has to be paid? 7th of subsequent month and 30th of April. So what is the 7th of subsequent month and 30th of April? All of us are aware of this. So whatever the deduction done in a particular month, that is from April to February, that needs to be remitted within 7th of subsequent month, excluding the deductions that have been made in the month of March, where we have time up to 30th of April to remit that TDS payment. Then the next step is after deduction, after payment, we have to file the returns. What is the periodicity and what are the forms used for filing these returns? Under section 195, it's a quarterly return which we need to file. It is similar to the resident payments. There also it is quarterly returns. For section 195 also it's a quarterly return and it should be filed in form 27Q. Are there any due dates? Yes, there are due dates for this. So after the end of the quarter, 1 month from the end of the quarter, that is first quarter is April to June, so 31st July, like that 31st October, 31st January. But when it comes to last quarter, even though the last quarter ends on January to March, but due date for making the TDS payment is 30th of April. From that date, 1 month, that is 31st May is the due date for filing the returns, quarterly returns. Then due dates for issuance of certificate. After filing the returns, you have a due date 15 days from the end of the, or 15 days from the due date for filing the return of TDS. We have to issue certificates. The due dates will be from here, 15 days will be 15th August, similarly 15th November, 15th February and 15th June. So all these due dates, what I'm saying, this is as per the Income Tax Act, read with income tax rules. So because of this pandemic and so many other reasons, there is change in the due dates in the previous year and current year. So I'm not discussing those things. This is as per the Act and rules, which is there. I'm telling about this due date. So for whatever amendments or extension of dates are there, that we may have to substitute for that. Now we have understood these four stages, how it has to be done, like when it has to be deducted, how it has to be paid, when it has to be paid, what are the returns that has to be filed, what is the periodicity, the due dates and due dates for certificate. Now let us try to understand what happens if I am not done that. Like a deductor has to do all these things. In this all these stages, when you see in this TDS compliances, majority of or maybe 95% of the work is done by the deductor. So it's only deductor based that all these provisions are there. With respect to deductee, it's only very less, maybe less than 5%. The activity of a deductee is there, but majority of the process has to be done by the deductor. Now, what happens if these stages are not complied with, not deducted? So we know that deduction has to be done, but deductor has not deducted. What happens? One is disallowance of expenditure under section 40A1. So if a person who has made a payment to a non-resident where it is subject to TDS, but he has not deducted TDS, then there will be disallowance of expenditure under section 40A1. Apart from that, there is also penalty under section 271C. So 271C is 100% penalty equal to the amount of tax that needs to be deducted. Say for example, if 1 lakh is the payment or 10 lakhs, let us take 10 lakhs is the payment that needs to be made to a non-resident, on which 10% is the TDS, which comes to 1 lakh. So the resident has made a payment to non-resident without deducting TDS of 10 lakh rupees. Then penalty under section 271C will be 1 lakh rupees. That is equal to the TDS amount not deducted. Apart from this, disallowance of expenditure. So he is claiming that 10 lakhs as expenditure. Under 40A1, 100% of that expenditure will be disallowed. Then payment. Now the next thing is he has deducted. First stage he has done deducted, but he has not paid. What happens? So deducted but not paid again. There will be disallowance of expenditure under section 40A1, similar to this. Then there may also be prosecution under section 276B. Prosecution may be from 3 months to 7 years as such. So prosecution will be under section 276B also. So if he has not deducted, there will be penalty. If he has deducted but not paid, then he may also be subject to prosecution as such. Then delayed payment. Now the next stage is he has deducted, but it is not that he has not paid, but there is a delayed payment. What is the delayed payment? Means we have seen what are the due dates, that is 7th of subsequent month and 30th of April, but he is making payment after that due date. So what is the consequences of a delayed payment? There will be interest in the section 201. So from the due date to the date of payment, 1.5% is the interest that needs to be charged for a month or part of a month. The next one is he has deducted and he has also paid, but he has not filed the returns. What happens? He has not filed the returns. Penalty under section 271H will be attracted, which ranges from 10,000 to 1 lakh rupees. Now, it is not that the case of not filing the returns, it is a delay in filing the returns. Then there will be fee under section 234F, which we are all aware, 200 rupees per day of delay. The last one, certificate. He has done the first 3 stages, but he has not done the last stage, that is not issued. What happens? Penalty under section 272A will be attracted. For every day of delay after the due date, there is 100 rupees penalty. 100 rupees per day of delay will be there for not issuing the certificates. Now we have understood the 4 stages, what has to be done, when it has to be done. Also understood the 4 stages. If it is not being done, what will be the consequences? Now, if I see this 4 stages, the first 2 stages, the deductor has to comply with is with respect to the government. Then the next 2 stages, that is returns and certificate, is with respect to the deducting. So the compliance in these two stages is with respect to the deductee, and the compliance with the first two stages is with respect to the government as such. Why is that so? Means like if the deductor deducts the TDS and makes the payment, for him the expenditure will be allowed. So whatever he has deducted and he is remitting to the government, for him the expenditure will be allowed. But he is not filing the returns and not issuing the certificate, the deductee will not get the TDS credit. So these two stages, the last two stages is with respect to the deductee. The first two stages is with respect to the government. So we should ensure when we are dealing with the clients that they comply with all the four stages. It's not that they do deduction and make the payment and keep quiet. We should ensure that they file the return and also ensure that after filing the return, they generate the TDS certificates and give it to their respective deductees as such. Even though the certificate is not given, practically it's not a very big problem, because when you file the returns, the credit will go and sit in the 26 years. So for the deductee, you can take the credit. But as this is a procedure that needs to be followed. It's always advisable to tell our clients that they have to generate the certificate within 15 days and send it to the respective deductees as such. Now let us move on to the comparisons. Similarities. Now let me do the comparison, that is similarities between resident TDS and non-resident TDS. The first one is date of deduction. So the date of deduction, as I said, the at source, that is the date of entering a transaction in the books of accounts. So both in resident TDS and non-resident TDS, it is credit or payment, whichever is earlier in majority of the cases. Few cases are there where it is on payment, but otherwise it is credit or payment, whichever is earlier. Then date for remittance is also similar in resident TDS and also non-resident TDS, that is 7th of subsequent month and 30th of April. Then date for returns also same. The same due dates are applicable for both resident TDS and non-resident TDS. Of course, for resident TDS, there are 24Q and 26Q. But for non-resident TDS, it is 27Q. The form will change, but the due dates are same. Date for certificates also remains same for both resident TDS and non-resident TDS. Nil or lower certificate. Under resident TDS, nil or lower certificate can be applied by payee, that is the person who is receiving the income under section 197. When it comes to non-resident TDS, it can be applied by payee both under section 195 subsection 3 and section 197. Assessee not in default. So if payee does certain activity, so there is something called assessee in default. Section 201 talks about assessee in default, where the person who is making a payment, if he is supposed to deduct TDS, not deducted, what will happen? So he will be considered as assessee in default. So he has deducted and not remitted, or he has not deducted. So then he will be considered as assessee in default. But there are certain, there is some proviso in that particular section 201, which talks about the assessee will not be considered as is in default. Here assessee means what I am referring to is the deductor. The deductor will not be considered as in default, even though it has not deducted TDS. When is that? When will that happen? Means if the deductee or the payee does certain activity. What are those activities? So whatever the income that has been paid by the deductor to the deductee, that has to be considered by the payee in his income. That is, he has to consider that amount as his income. Then he has to pay the relevant taxes for that, on that, the applicable taxes. Then he has to file his return of income. So earlier I told an example for what do you call this, penalty, like a resident is making payment to a non-resident of rupees 10 lakhs but not deducted TDS. So I said there will be penalty, disallowance of expenditure and all. Now with these things like assessee not in default, if payee does certain activities, I assume that same example, the non-resident has considered this 10 lakhs in his computation of income. He has taken to his books of accounts. Then whatever the tax is applicable on that, he has discharged the tax liability and he has filed his return of income. Then the person who has not deducted TDS, in this case, the example, the resident who has not deducted TDS, he will not be considered as assessee in default. So there won't be a situation where this expenditure will be disallowed. But there may be a situation where the department may ask him to pay the interest on that particular amount for which he has not remitted the TDS. So pay does certain activity. The person who was supposed to deduct but not deducted, he will not be considered as in default. So assessee not in default. Earlier, this provisions was applicable only for resident TDS. That is, the recipient was a resident, but now it has been extended to even to non-resident recipients. So even under non-resident TDS, this particular provision is applicable. Then PAN. For residents, they have to give either PAN or Aadhaar. But when it comes to non-residents, they have to give only PAN. Gross amount, so the same thing applies to both the resident and non-resident TDS. That is, TDS to be done on gross amount, not on other taxes like GST and other taxes. You need not consider on that. You need not do the TDS. Only in the gross amount you have to do the TDS. So these are some of the similarities what I thought to share with you with respect to resident TDS and non-resident TDS. Now let us see what are the differences in resident TDS and non-resident TDS. So basically we have to understand these differences. We have to remember similarities is same both for resident and non-resident. These differences is what we have to remember a bit more. So the TDS rates under resident TDS, the TDS rates will be specified in the respective section. So you take any resident TDS provision, say section 197, 194C, 194A, 194J, I, J, whatever sections you take, 194K, each and every section you will have a rate specified in that particular section itself. But when it comes to non-resident TDS, it says it will not specify the rates. Section 195 will not specify the rate of TDS. It talks about the rates or rates in force. Rates or rates in force defined in section 2, subsection 37A, subclause 3 with respect to section 195, where it says the rates or rates in force means at whatever is beneficial to the assessee. There are two rates which is there in the section 2, subsection 37A. It says whichever is beneficial or lower you can consider. What are those two rates? One is the rates as specified in the respective Finance Act. So Finance Act, if you see, you will have the rates. Schedule 1 of the Finance Act, you will have Part A, B, C. Part A is for the current year's tax. Part B will be for TDS. And Part 3 is for advanced tax calculation. That is for the next year. So the rates specified in that particular Finance Act are double taxation avoidance agreement rate, whichever is beneficial or whichever is lower, the assessee can take. So that is what is explained as rate or rates in force under section 195. That is for the purpose of section 195, rate or rates in force defined under section 2, subsection 37A, subclause 3. Then the limit. So there are limits specified in respective sections for resident TDS. So any section you take, there will be a limit. Like if you take 194I, where the payment is made towards rent, it says up to 2.4 lakhs, there is no TDS. Beyond 2.4 lakhs, there is a TDS liability arises. But when it comes to non-resident payments, no limit specified, taxable from rupee 1. So when you are making payment to a non-resident, you need not worry about the limits. So there are no limits for non-resident payments right from rupee 1. That will be subject to TDS. Type of deduction: tax deduction at source and withholding of tax. So this, what is the difference between these two phraseology, that is tax deduction at source and withholding of tax? Basically, the characteristics are same. So both are same. Tax deduction at source is also, we are deducting a portion of tax from the payment that has been made. In withholding of tax also, it is a method of deducting the tax portion. Now, if I have to see, if I have to differentiate between these two terminologies or phraseologies, usually for resident payments, we say it is tax deduction at source. When it comes to non-resident TDS, we will say it is withholding of tax. So what is the difference? Take an example of resident TDS. Say, let us take an example of section 194J, where all of us are chartered accountants. If one of our clients is making payment to us, and if it exceeds the limit under 194J, they will deduct TDS at 10% and they will give it to us. Ultimately, my tax liability may not be in 10%. It may be in 5%, it may be 5 and 20%, and also in 30%. So the average rate of tax what I may be paying may be more than 10%. but the TDS will be done only at the rate of 10%. So it is not the actual tax liability or tax deduction. It is only as specified in the section. Say suppose another example, if I take 194C for a contract payments, there will be 1% or 2% based on the depending upon the status of the assessee. So let us take 2%, not individuals in HGF, 2%. We are making a payment to a firm or a company at 2%. But the ultimate tax liability may not be 2%. They may be paying at 30% or 25%, whatever it is. So tax deduction at source is done at a specific rate. So how do we differentiate between TDS and withholding of tax? That is WHT, that is withholding of tax. When it comes to non-resident TDS, we are not deducting the tax at a specified rate as such, but we are deducting the tax, or I should say, we are deducting his entire tax liability. So whatever may be the tax liability of a non-resident, the entire thing we are withholding. So withholding of tax means it is not some percentage of tax we are withholding. We are withholding the entire tax liability from a non-resident. So that this can be one difference between the words tax deduction at source and withholding of tax. Surcharge and cess. Whether we are to deduct surcharge and cess or apply surcharge and cess for deducting TDS for resident payments. No, only specified TDS rate is deductible. That is whatever the rate that has been given. So the example what I gave earlier, 194J means 10% we deduct. 194C means either 1% or 2% depending upon the assessee. Only that TDS will be done on that particular rate as such. But when it comes to non-resident TDS, yes, surcharge and cess to be added to withholding of tax. So this is where I said, now withholding of tax means entire tax liability of a non-resident we will recover. So when we are talking about entire tax liability, wherever surcharge and cess is applicable, we have to add that also, and we have to recover or deduct from the non-resident payments. Here one thing we should understand, I said the rates are rates in force, lower of the two rates, that is Income Tax Act rate and DTA rate, whichever is beneficial or whichever is less, we will take. Whenever you take income tax rate, for that you have to add surcharge and cess. But when you take DTA rate, you need not add surcharge and cess, because whatever the DTA rate, it is inclusive of surcharge and cess. So that will be the final rate. Only when you are deducting tax on taking into consideration the income tax rate, for that we have to add surcharge and cess. Nil or lower certificate, payer can't apply for the certificate. So under resident TDS provisions, if a deductor is making payment to a deductee, only deductee can apply for lower or nil reduction TDS under section 194(7). So payer can't apply under resident TDS, but when it comes to non-resident TDS, yes, payer can also apply under section 195 subsection 2. So payer can apply under section 195 2. So that is the difference between resident TDS and non-resident TDS. Information. Payer need not furnish any information. So with respect to resident TDS, if he follows those stages, that is deduction, payment, returns and certificate, then he need not do any other, he need not furnish any other information. But when it comes to non-resident, along with what he is supposed to do, the 4 stages, he has to provide certain information. He has to furnish certain information in Form 15CA and Form 15CB, wherever it is applicable. Disallowance under section 40A1A, we understood when the disallowance will be there. The resident TDS provisions, the expenditure will be disallowed at 30%. When it comes to non-resident payments, the disallowance will be at the rate of 100%. So the example 10 lakhs non-resident payments, not TDS not deducted, entire 10 lakhs will be deducted, means disallowed. When the same thing applies to a resident payments, instead of 10 lakhs, 30% of that 3 lakhs will be disallowed. Other legislations, no need to refer other legislations except Income Tax Act and the related things like income tax rules, circulars, notification, case laws if required. But when it comes to non-resident TDS, the person has to refer DTA and FEMA provisions wherever it is applicable. So for resident TDS, only the Income Tax Act and the related legislations. But for non-resident payments, apart from Income Tax Act and other related laws, he has to refer DTA and FEMA wherever it is applicable. So these are some of the differences. This we need to remember when we are dealing with resident TDS payments and non-resident TDS payments. Now we'll move on to the general aspects of section 195. Now let us see the applicability of this. So it applies to a non-resident not being a company or to a foreign company. So whenever a payment is made to a non-resident who is not a company or to a foreign company, section 195 will be applicable. So these are the general aspects of section 195. So whenever we talk about section 195, it applies to a non-resident. Who should be a non-resident? Not being a company or to a foreign company. So all the persons, all type of persons who are non-residents, section 195 will be applicable. So the non-resident should be a deductee, not the deductor. So the deductee is non-resident, section 195 will be applicable, irrespective of the deductor. Deductor can be resident and non-resident also, but deductee should be a non-resident. So then only section 195 will be applicable. Deductible on what all the sums that TDS is applicable under section 195. 195 says this particular provisions of TDS will be applicable on interest payment. So whenever an interest is paid to a non-resident, this section 195 is applicable, or any other sum chargeable under this act. So any sum chargeable, other sum chargeable under this act. What is that chargeable under this act? Of course, we have seen section 4, which is a charging section. Then we should move on to section 5, which talks about the scope of total income. Then we have to go to section 9, which talks about income deemed to accrue or arise in India with respect to a non-resident. Then also we should see section 14, which talks about heads of income. There are 5 heads of income, that is income from salary, house property, business or profession, capital gains and other sources. Whatever is chargeable to tax under this act means under the Income Tax Act 1961. So whenever we are making payment to a non-resident, we should see what is the nature of income, whether that income is subject to taxation under the Income Tax Act 1961. We have to see if it is chargeable to tax. If that income is subject to tax under the Income Tax Act, then the person who is making that payment to a non-resident is supposed to deduct TDS under section 195. What are the rates? Rates in force already I have explained. Limit, this also I said, no limits prescribed. TDS starts from Rupee 1. Payer status. Who is the payer? What is the status of the payer? The payer status means it can be a government. So whenever a government is making payment to a non-resident, this TDS provisions will be applicable. Whenever a resident is making payment to a non-resident, TDS is applicable. And whenever a non-resident making payment to another non-resident, TDS will be applicable. Now you must be wondering how outside country, if one non-resident makes payment to another non-resident, how come Income Tax Act will be applicable for them? How come they will deduct TDS from one non-resident payment to another non-resident payment? That it's not that in all cases that will be applicable. In exceptional cases that will be applicable. Now to just understand this, whenever the government, that is the central government or state government, makes payment to a non-resident, TDS provisions will be applicable. Resident making payment to non-resident. Generally, resident making payment to non-resident, it is subject to TDS, generally. But exceptionally, it is exempted. What is that exception? The exception is when a resident is making payment to a non-resident, towards, there are various types of income, categories of income, both under section 9 and if you see the DTA, various types of heads of incomes are there. Whenever a resident is making payments to a non-resident towards interest, fees for technical services and royalty services, and those services are utilized by the resident for setting up a business or doing a profession outside India, then that particular amount will not be subject to TDS. So that will be exempted. So what I said, generally resident making payment to non-resident is taxable, but in exceptional cases, resident making payment to non-resident will be exempted. What is that exception? When the services are utilized for a business or profession set up outside India or to earn any income or any source of income outside India, then that will not be considered. Means that will not be considered as income chargeable to tax under the Income Tax Act in the hands of non-resident, for which there is no need for deducting TDS. Now, non-resident making payment to non-resident, generally it is exempted. So if you see one non-resident outside India making payment to another non-resident, it cannot be, it will not be, we cannot say that they are subject to TDS. So non-resident making payment to another non-resident is generally exempted. But there are certain exceptional situations where a non-resident making payment to another non-resident is subject to tax in India. So we are talking about the recipient being a non-resident. So which is the circumstances where a payment made by non-resident to another non-resident is subject to tax. So the same three types of income, here also it is referred as any interest, royalty or fees for technical services, which has been paid by one non-resident to another non-resident, and those services are utilized by the non-resident, that is the person who is making the payment, towards a business or a profession or to earn any income from any source in India, then that person who receives, the another non-resident who receives this particular type of income, it will be income deemed to accrue as in India, and then provisions of section 195 will be applicable. So these are the situations where non-resident making payment to another non-resident will be subject to tax in the hands of that non-resident. Then the payee status. Now we understood the payer status. Then the payee status, non-resident. So I said it's applicable only to a non-resident, and payee status to be determined as non-resident at the time of deduction. Usually when we file the return of it, we know that income earned in previous year subject to tax in the assessment year. When charging the tax in the assessment year, we will find out the residential status at the last day of the previous year or first day of the assessment year. So whatever you earn in the previous year, at the end of the year, we will determine the residential status, whether he is a resident, non-resident, or so, something like that. But during the financial year, when you are making payment to a person, when you have to determine his status, whether you have to wait till the end of the year and determine whether he is a resident or non-resident, or at the time of deduction, you have to decide whether he is a resident or non-resident. So it says that the status of a non-resident should be determined at the time of deduction, not at the year end. So practically it is not possible for everybody to wait till the conclusion of the year and do the TDS provisions. On the date of the time of deduction, that is at source, whatever may be his position, that is a status, based on that we have to deduct the TDS. So there may be situation where on the date of deduction the person may be non-resident, but subsequently he can become resident. It may be vice versa also. On the date of deduction he may be resident, but at the end of the year he may be non-resident. So at the time of deduction we have to ascertain his status and we have to discharge our TDS liability as such. So the deduction, this also I said, on credit to account of payee or payment whichever is earlier. There are certain exceptions under 195. Whenever the interest payment is made by the public sector bank or public financial institutions or government, then the interest payment, the TDS liability will not be on credit or credit basis. Only it will be on the payment basis. So whenever a public sector bank, that is a nationalized bank, is having a FD or a non-resident deposits, when you are crediting the interest to the non-resident account, you need not deduct TDS at that particular point of time. Only on payment basis, TDS has to be done. But this particular provisions will not be applicable for cooperative banks or foreign banks. So while doing the audits, like bank audits, when we are doing this, what do you call this, nationalized banks, we can apply this rule. When we are doing the cooperative banks, it's not on payment basis, credit or payment, whichever is earlier. So the same thing will apply. Basis of deduction, TDS done on gross amount paid or payable. Lower deduction, this also we have little bit we understood that payee can apply for nil or lower deduction of tax under section 195(3) and 197. Payer to apply, this also payer can apply for nil or lower deduction of tax under section 195(2). exemptions. I said whatever the amount that has been paid to a non-resident is subject to TDS in section 195 and the provisions of section 195. There is one exception. There are two exceptions actually. One is the dividend which was exempted earlier. Now there is taxable, so that is not an exemption. So the salary income is chargeable under section 192 and not under section 195. So whenever you make a payment of in the nature of salary, even if you are making payment to a non-resident, section 195 will not be applicable for that. That will be subject to TDS under section 192. Person responsible. So person responsible, who is the person responsible to do this tax deduction with respect to the payments made to non-resident? Person who pays. Person means we know defined under section 2, subsection 31. Various types of persons are there. So anybody like any individual, HUF, firm, company, anybody who makes a payment to a non-resident, they are the persons who are responsible to do the TDS. When it comes to company, along with the company, even principal officer of company is responsible for deducting tax at source. And there is one situation, authorized dealers. Authorized dealers means the bankers who are remitting this particular income to the non-resident. But the authorized dealers are also supposed to are also considered as person responsible for deducting in certain cases. What are those cases? When the foreigner, that is a non-resident individual, have invested in Indian stock as a foreign exchange asset through the foreign currency, and if it is a long-term capital asset and when it has been sold, then the proceeds has to be transferred to a non-resident account. In those circumstances, the authorized dealers will be the person responsible for deducting tax at source and remit the balance amount. PE declaration. So we have something called the concept of permanent establishment. Under the international taxation, we deal with this. We keep on discussing about this permanent establishment declaration. So whenever we are dealing with a non-resident, first we have to obtain whether they have a permanent establishment in India or not. If they have a permanent establishment in India, then the provisions will change. The section 195 may not be applicable because they may also be considered as a resident. So we have to first obtain a declaration that they don't have PE in India. So no PE permanent establishment declaration to be obtained from the non-resident. Then the TRC. TRC means tax residency certificate or form 10F to be obtained. So whenever you are dealing with a non-resident, you should get his tax residency certificate. So where is his tax residency? Whether in country A, country B, country C, because a person may be having businesses across more than one country. So we should ascertain where he is the tax resident. So we have to get a tax residency certificate. There are two things where you will get the advantage of getting TRC is, one is you will know from which country he belongs to, so that whenever there is a double taxation avoidance agreement between India and that particular country, that we can apply. The second thing is to claim relief or benefit under DTA, TRC is must. Not even Form 10F, TRC is a must. So it is a key to open the DTA between India and that particular country. So we have to obtain TRC from the non-resident. Poem. Of late, there is an amendment to section 6, subsection 3 with respect to companies, where it says even in case of foreign companies, we know the residential status of the company, all the companies, the Indian companies registered in India are resident companies. Other than that, foreign companies are all non-residents. But with the introduction of this concept of place of effective management in case of foreign companies, they will also be considered as residents. So whenever any part of the previous year, if the place of effective management is in India, then that particular foreign company is also considered as a resident company. So we may have to obtain the poem, that is whether for a foreign company, whether they had a place of effective management in India, all those details we have to obtain from a non-resident foreign company. Business profits. So usually as per the DTA, we have got a relief where it is in the nature of business profits, and if that particular entity doesn't have a PE in India, that business profits will not be subject to tax in the other contracting state. So there is any transaction between India and some other country, say country A, and that particular transaction is in the nature of business profit, that the entity of country A doesn't have permanent establishment in India, then this will not be subject to tax in India. That will be subject to tax only in country A. So if no non-resident has no PE in India, then business profit is not taxable in India. Then a certain DTAs, you must be aware, which talks about a make available clause. What do we understand by make available clause in double taxation avoidance agreement? Whenever there is a transfer of services, or whenever there is a services rendered, for example, technical services, just rendering the technical services will not make available entire technology to the recipient. If there is no make available clause, or if there is no make available of the technology, where a non-resident is only giving the services, but he is not making available the technology in that particular services to the recipient, then that is not considered as royalty or fees for technical services, then that will be considered as a business income. If it is considered as a business income, if they don't have a PE in India, then that will not be subject to taxation in India as such. So whenever you come across this DTA, that is the make available clause in a particular DTA, we have to analyze whether the services has made available the technology. Just to give an example, it's not related to this taxation as such. I'll give you another example. If for a hungry man, if you give a fish, it will feed him for that particular day. And if you teach him fishing, it will feed him for his entire life. So this is how we are making available the technology. How to catch a fish is what he is teaching. Coming to this practical thing, say suppose if you are getting a particular software, they will only give you the license to use the software. So they are not making available the technology, how to prepare the software. They are not giving all the codes, whatever is there, the codes of the source code of that particular software, where you can reproduce that or you can redesign software, all those things. So they are not making available to you entire technology as such. So that is where you have to differentiate between whether the services has been made available or only services has been given only as a right to use that particular services. If make available is not there, and if that make available clause is there, certain DTA says if it is not, technology is not made available, it will not be considered as royalty or fees for technical services. Then it should be considered as business profit. If it is a business profit and if they don't have a PE in India, then that is not subject to taxation. Secondment, we have situations where employees assigned to India for a particular project. In case of multinational companies, there is a concept called secondment or assignees, where a company may have a particular multinational company may have its offices across various countries, maybe more than 2 countries, or maybe even in 30-40 countries. Certain MNCs will have their presence as such. If a particular project, say suppose India wants to do a particular project, it doesn't have that required skilled employees as such, but in country A, those employees are there. So the country A will send those employees to India for rendering services for that particular project. So this is called as secondment. That is assignees, where one of the country assigns its employees to another country for execution of a particular project as such. So whenever this people are assigned to another country, when they'll be considered as in the roles of Indian company, and means they'll be given the salaries, and whatever the salaries that has been paid to that Indian employees, that will be, they will do the TDS and remit to the government as such in section 192. But it so happens that when say suppose country A is deputing certain employees to India, there will be certain salary structure in country A. So they will say wherever you go, whether you work in country A or India or country B or country C, wherever you go, that particular salary what you are getting, that will be assured. So there won't be any changes. Okay. So then that particular salary will be paid in country A to the employee, but when he is working in India, only the perquisites and allowances will be paid in India. Other things it will be credited to his account in country A. Now, whatever the salary that has been paid in the country A by that particular company, that will be they will charge, they will raise an invoice and country that is India, and Indian company will reimburse that particular amount. So this is where the assignment charges will be paid. Now, when India makes this payment to country A, whether the TDS liability will be there. So what is this nature of expenditure? Whether it is reimbursement of expenditure or it is a technical fee that has been paid to the country, that is the other company as such. There are two situations. One situation where they only deploy the employees, that is country A will only send the employees, and this employees will be working in India under the supervision and guidance of the company in India. So they will be reporting to India, and whatever the instructions given by India, that Indian company, they will be executing a particular project. And the country A company will only ask for the reimbursement of the actual salary that has been paid without any markup or upliftment. Then that will be considered as reimbursement. Usually there won't be any tax liability on that. The other situation is the employees of the company in country A, they'll be deployed in India and they'll be directly reporting to the company in country A, and taking their instructions and guidance, they'll be working in India. Then country A will charge for that to Indian company. Then Indian company will pay that amount to country A. In this situation, it is considered as it is a technical services because they are rendering certain technical services in India because they are guiding under their control and supervision. These employees are working. Then that will be considered as a technical service fee, and there will be TDS on that particular payment as such. So there should be differentiation between the same secondment is same thing. The concept is same, but how they are employed in India, who is taking care of them, whether the Indian company or the foreign company, depending on that, we have to see the tax liability. Now coming to some of the other things, like practically there will be something called apportionment of expenditure. Say like a group company will incur certain expenditure. It may be buying of a software or something like that, and based on the to the subsidiary companies, based on the users or based on the number of users or something like that, it will apportion the expenditure. So whether this apportionment will be outside the purview of TDS or it is under the subject, it is subject to TDS as such. So whatever the apportionment is made, we have to see the nature of payment. If the nature of payment is subject to TDS, even if it is an apportionment of expenditure, even if the subsidiary company is making payment to its group company, TDS is applicable. Then reimbursement. Just now I explained how this reimbursement works. Depends upon the nature of payment. Even though it is just because it is in the name of reimbursement, we cannot construe that it is not subject to TDS. Depending upon the nature of payment, even reimbursement will be subject to TDS. But there are certain general expenses where there is no upliftment. Like there may be some traveling expenses, medical expenses, insurance expenses, visa charges, immigration charges, or tax liability. All these things will be charged from one so what do you call the group company to another group company, and that will be an actual basis, that is actual cost that has been incurred without there being any profit element, that is no upliftment. In those cases, we can say that it is actual pure reimbursement of expenses without there being any upliftment of that, and whatever that expenditure you record in your books, that is not falling under any of the TDS provisions, or it is not income in the hands of a non-resident, then that need not be subject to TDS under section 195. DTAA, double taxation avoidance agreements to be examined, which I have already spoke. Cash withdrawal, section 194N, we know whenever a person is withdrawing cash from his own account, TDS is applicable exceeding the limits, that is 20 lakhs or 1 crore as the case may be. That applies to even a non-resident. If a non-resident is withdrawing cash from his own account in India, then section 194N is applicable for that also. Advance payment, whether advance payment TDS has to be required. Yes, Similar to that, whatever that resident TDS, we know if end payment is subject to TDS, then yes, even for advance payments, TDS has to be deducted. Payments in kind. If sum chargeable to tax, then it is subject to TDS. So whenever, whatever the sum you make, whatever you are making payment to a non-resident, whether in the form of sum or in the form of kind, but that value is an income in the hands of non-resident and is subject to tax in India, then even if you are making something in kind, that is subject to TDS. Because if it is sum chargeable to tax, then it is subject to TDS under section 195. Coming to the rules, some of the important rules that you may have to know for TDS provisions under section 195, Rule 28, 29B, 29BA, 37BB, and 37BC. Rule 28 is with respect to section 197, where the payee applies and using form 13 for lower or nil deduction of TDS. 29B is with respect to 194(3), where the payee can apply either using 15C and 15D. 29BA is with respect to 195(2), where the payer can apply for lower deduction of TDS using form 15E. Then 37BB is a rule with respect to the additional information that needs to be furnished by the deductor, that is in form 15CA and 15CB. This is the authorized dealer who has to file a return in form 15CC. Then 37BC, some exceptions to some of the like the requirement of PAN. Then 27Q, we know that is a quarterly return that needs to be filed for this non-resident payments, 27Q. Then information to be filed by deductor in form 15CA. So that is the information which we are talking about under section under Rule 37BB. It has to be filed by deductor in form 15CA. There are four parts: Part A, Part B, Part C, and Part D for form 15CA. Then certification for resident TDS, there is no need for certification, but for that is non-resident payments under section 195, wherever it is required. So only for Part C, wherever the situation is warrants for Part C of Form 15CA, Form 15CB is required. That is the Chartered Accountant certificate is required. And what is that we certify in Form 15CB? Two things we certify. One is the nature of remittance and rate of TDS. So the nature of remittance, as I told you earlier, in DTA, if you see, there are almost 20 to 21 types of incomes. So we have to certify the nature of remittance. Then the rate of TDS. What is the rate applicable? Whether income tax rate or DTA rate, as beneficial to the assessee, what is the rate of TDS? So when we, as a chartered accountant, certifying a Form 15CB, two things we are certifying. One is nature of remittance and rate of TDS as such. LRS and specified list. LRS under FEMA is called the liberalized remittance scheme, where an individual can discharge or pay up to 2.5 lakhs US dollars in a particular financial year. And there are certain specified lists. The government has given certain specified list where for both LRS remittance and the items covered under this specified list, there is no need for Form 15CA. So when Form 15CA is not required, even Form 15CB is not required. Surcharges already have discussed. For payment to non-residents tax to include surcharges. Again, I am repeating, only for income tax rate, surcharges to be added, not for DTA rate. PAN or other compulsory to be provided under section 216AA. There are certain exceptions which has been given in Rule 37BC that we will see. So PAN has to be provided by the non-resident. TAN for required to deduct tax. So TAN is required for the deductor to deduct tax and file his returns. Filing of ITR, certain sections exempt non-resident from filing of return of income. So when I said withholding of tax, where entire tax liability of non-resident has been deducted, so there is some cushion or some privileges to the non-residents where they need not file the return of income because entire tax liability has been deducted. So there won't be any question of filing the return of income. Foreign exchange. amount payable in foreign exchange to be converted using Rule 26 and 115. So Rule 26 says the conversion rate of that is the foreign currency into Indian rupee will be at SBI TT buying rate. And what all the dates to be used, we may have to refer section Rule 115, where it says different dates for different types of income and such. Punishments, we know, disallowance, interest, fee, penalty, and prosecution. Penalty under 271I, there is one more penalty where a director who is supposed to furnish certain information, if he has failed to furnish that information or he has inaccurately furnished certain information, there will be penalty of rupees 1 lakh for every failure of furnishing information or not furnishing information. For furnishing improper information or not furnishing any information, there will be penalty under 271I of rupees 1 lakh. Revised return, yes, returns can be revised any number of times, no due dates, adjustment. Any excess TDS made can be adjusted with previous year and next year. Intimation. So we know that section 143(1), which gives us intimation, that is summary assessment. Similarly, whenever you make a TDS returns within 1 year from the end of the financial year, you will get intimation under section 200, subsection A. So if when you get an intimation under section 200A, if there is some mistake or if you feel that that is not correct, you can go for rectification of that particular intimation under section 154. Then appeal. So order will be given issued under section 201, where if certain things are not done, so the order will be issued for payment of TDS, interest and penalty. And if the assessee is agreed by that particular order, he can go on an appeal for the orders received under section 201. Assessee not in default, I've already explained, but there is one requirement apart from the payer doing certain activity. There is one more thing that is a requirement, like if you that has been given in Rule 37 BCA and Form 26A. So whenever the payee has done all those three things, that is, he has considered that income, paid the tax, and filed the return of income, he has to get a certificate. Who has to certify that? A chartered accountant, practicing chartered accountant has to certify this particular thing, that he has considered this income, paid the tax, filed the return of income, and it is in Form 26A that he has to issue a certificate to the deductor. If he produces that to the department, he will not be considered as assessee in default. Rounding off, TDS amount to be rounded off to the nearest rupee 10 under section 288B. Decimal, the entire returns, that is tax returns that you will be filing for TDS, tax rates can't be given for more than 2 decimal points. So if you get a tax rate of say more than 2 decimals, 3 decimals if you get, you have to round it off to the nearest 2 decimals as such and do the TDS. Otherwise, we cannot file 27Q. Non-filers of ITR, the new section that is 216AB, which has been introduced in this particular financial year, it will apply to non-residents also, provided they have PE in India. If any non-resident has got a PE in India, he can be considered as a specified. He can be considered as a specified person. DSC for Form 15CA, it is not compulsory. For Form 15CB, it is compulsory. So DSC is compulsory for filing Form 15CB. So every chartered accountant who has to file certify his Form 15CB and upload it in the website, he has to compulsorily have DSC. UDIN to be generated and uploaded in IT portal for every Form 15CB that has been generated. So these are some of the other sections where you can also come across this non-resident payments as such. So these are some of the general aspects of section 195. I thought I will deal with you people, discuss with you people. Now let us move on to overview of section 195. Are there any questions so far? Is it okay? Should I take some questions and any questions?
No questions, sir.
No questions. Okay.
Yes, sir.
Okay, let me discuss this overview of section 195. Section 195 has got 7 subsections. 195.1 deals with scope and conditions for applicability. 195.2 discusses about application by payer for lower withholding of withholding certificate. I said payer can also apply under section 195.2. 195.3 where application by payee for nil withholding certificate can be applied. 195.4 and 195.5 are procedural things. 195.6 talks about payer shall furnish information. That information is in form 15 CA and 15 CP. Then 195.7 assessing officer to determine appropriate proportion of some chargeable. Let me quickly go through these provisions. Most of this already explained. So I'll quickly run through this section 195. So section 195, subsection 1, which talks about scope and conditions for applicabilities. It says any person responsible for paying to a non-resident, not being a company or to a foreign company, any interest. Not being interest referred to in section 194 LB, LC or LD, or any other sum chargeable under the provisions of this act, not being income chargeable under the salaries, shall, at the time of credit of such income to the account of the payee or at the time of payment thereof, in cash or by issue of check or draft or by any other mode, whichever is earlier, deduct income tax thereon at the rates in force. So few of the concepts in this particular section. So this is what I should say, the word by word section 195. If you open section 195, everything you can see that the entire section I just put it here. So let us try to understand each and every sentence or each and every word possible in this particular definition. That is section 195.1. It says any person. So person, we know, defined in the section 2 subsection 31. So any person means any person under section 2 subsection 31, any person who is responsible for paying. So we have also understood person responsible for paying, which has been defined in section 204. Earlier I explained to you who are the persons responsible for paying. A separate section is there, section 204, which deals with person responsible for paying. Any person responsible for paying to whom? To a non-resident, not being a company or to a foreign company. How you will determine a person as a resident or non-resident? We have to get into section 6, which talks about the determination of residential status of a person. So either as a resident or non-resident. So it gives various methods of determining the residential status of all types of assessees. When it comes to individual and HUF, in residential status, we have two more categories. That is resident and ordinary resident, resident but not ordinary resident. Now, whether non-resident is defined, so section 6 says non-resident based on certain parameters, whether a person is a resident or non-resident. But there is a definition of non-resident under section 2, subsection 30 of the Income Tax Act, which says non-resident is a person who is not a resident. Okay. So resident, you will again go to that section 6. So non-resident is a person who is not a resident as defined in section 6. But it also goes to say, for the purpose of non-resident, this resident but not ordinary resident will not be covered. So it will be covered only with respect to few sections. That is section 92, section, I think one more section is there, 186 and one more section. So only this 3 sections, 168 and 186, 92 section, section 90. In these 3 sections, resident but not ordinary resident is also considered as non-resident. But when it comes to section 195, resident but not ordinary resident is not considered as a non-resident. So under section 195, when we have to do the provisions of section 195, both residents and ordinary resident and resident but not ordinary residents will be considered as residents. They will not be considered as non-residents. So RNOR for section 195 is a resident, not a non-resident. So how to determine a status of a non-resident? We have to get into section 6. And what are the types of payments? This also we have understood. Any interest payment. So there are three types of interest that is specifically defined in section 194 LB, LC and LD. Excluding this, any other interest made by a person to a non-resident is covering under this section 195(1) or any other sum chargeable under the provisions of this act. So what is chargeable under the provisions of this act? How you will ascertain? Again, you have to go to charging section. Then we have to get into section 5, which talks about the scope of total income, where it includes income received or deemed to be received in India. It also includes income accrued or arising in India or income deemed to accrue or arise in India. When we talk about income deemed to accrue or arise in India, then again we have to go to section 9, which deals with income deemed to accrue or arise in India with respect to a non-resident. Section 9 has to be referred. Then, as I said, section 14, which talks about the heads of income, the 5 heads of income. So any sum chargeable under the provisions of this act, we may have to refer all these sections. That is section 5. First, we should see whether this is covered in the scope of total income. So if an amount is paid to a non-resident, whether it is covered in the scope of total income, then we should see whether it is deemed to accrue or is in India, whether it is received in India. Then the heads of income we have to see. And if it is subject to tax, if it is chargeable to tax under the provisions of Income Tax Act, then this shall be a deduction shall be done when at the time of credit of such income to the account of payee or at the time of payment thereof by any of these modes, whichever is earlier. So first we have to, when you are dealing with a non-resident transactions, first we should see whether that is income in the hands of the non-resident. If it is an income, whether it is chargeable to tax under the income tax provisions. If it is chargeable to tax under the income tax provisions, at the time of credit or payment, whichever is earlier, you have to do TDS. How you have to do the TDS? What is the rate of tax? It should be at the rates in force. What is rates or rates in force? Section 2, subsection 37A, subclause 3, as already explained, whichever is beneficial, that is Finance Act rates or DTA rates, whichever is beneficial, in that rate you have to deduct TDS. So 204, as I already explained, any person responsible for paying is defined in section 204. So it discusses, 204, section 204 discusses about any person responsible for paying. So when I share this particular material, you can go through this in detail. Payments made to whom? There are twin conditions for attracting section 195. So for payer, it is credit or payment of income, and for payee, the sum chargeable to tax in India. That's what I was telling. The sum chargeable to tax in India only is subject to TDS section 195. Residential status of non-resident is determined as per test outlined in section 6. Non-resident definition in section 2, subsection 30 includes not ordinary resident in some cases. Generally, payments to not ordinary residents is outside the purview of section 195. As per section 2, subsection 30, section 195 will not be included for the purpose of considering not ordinary residents as non-residents. Now, to just understand in a particular table, the payer, the payee, and applicability of section 195. If the payer is a resident and the payee is a resident, section 195 is not applicable. If payer is a resident and payee is a non-resident, it is applicable. If payer is a non-resident and payee is a resident, again section 195 is not applicable. If payer is a resident, non-resident, and payee is a non-resident, it is applicable. If you see the applicability of section 195, the payee should be non-resident. So it depends upon the payee. When he is a non-resident, section 195 will be applicable. Sum chargeable under this act, as I said, we have to go through section 5, the scope of total income, and section 9, which defines income deemed to accrue as in India. And also the tax treaty, avoid a double taxation, provide relief for taxes paid in other treaty country. Apart from section 5 and 9, then when you have a benefit of getting into the DTA, that also you should see. Sometimes there will be a situation where the sum is chargeable to tax under the Income Tax Act, but it may be exempted as per the DTA. Then also TDS provisions will not be applicable. Then section 5 deals with scope of total income. So what is chargeable to tax in the hands of non-residents? Only these two items are subject to tax under section 5 in the hands of non-residents. What is this? Income received or deemed to be received in India during the previous year. So in India is very important. Any income received or deemed to be received in India is chargeable to tax in the hands of non-resident. Similarly, income accruing or arising or deemed to accrue or arise in India during the previous year. So this in India is very important in these two situations where only those two income in the received or accrued or deemed to accrue or arise in the hands of a non-resident will be subject to taxation. There are other things which are not, even though received by the non-resident, it is not chargeable to tax. It's not a sum chargeable to tax in the under the Income Tax Act. What are those? What are those incomes? Income accruing or arising outside India during the previous year from. So this is outside India in the hands of non-resident. Business controlled or profession set up in India. Any other source. Income received or deemed to be received outside India. So all these things, it is not subject to tax in the hands of non-resident. Now, if I have to quickly run through this section 9, which talks about income deemed to accrue or rise in India. I think already we are in 5:30. I'll just quickly run through this. So there are 8 subsections in 9.1, 9.11 to 9.18. So 9.1 talks about all types of income, like if a non-resident is getting any income accruing or arising, whether directly or indirectly, through or from any business connection in India. If the non-resident has got any business connection in India, or he has got any property in India, he has got any asset or source of income in India, or transfers a capital asset which is situated in India. So if you see, it covers almost all the heads of income. This is business connection means business income, property means income from house property, asset or source means income from other sources, capital transfer of a capital means capital gains. Except this income from salary, it covers all the heads of income. If non-resident has got any of these incomes, then it will be that income will be deemed to accrue or arise in India. Next, income from salary earned in India. In case of a non-resident, if he earns any income in India, that is considered as a salary income. So that will also be considered as income deemed to accrue or arise in India. But salary income, as we have understood, it will not be chargeable to tax or TDS under section 195. It will be the TDS provisions as per section 192 will be applicable. 913 talks about salary payable by government for service outside India. So these are all situations where the government has employed certain people as in the embassies, as ambassadors, or the staff who work in other countries as at the embassies. All those people, the government of India is making salary to those people, even though they are non-residents. That salary will be considered as income deemed to accrue or arise in India. Then dividend paid by an Indian company outside India. Then interest payment, royalty, fees for technical services paid by government resident or a non-resident. With respect to interest payment, royalty, and fees for technical services, I have already explained. When resident makes payment to a non-resident, some exceptional cases, it will not be income. And when non-resident makes payment to a non-resident, another non-resident, exceptional cases, it will be considered as income. 918 talks about gift received outside India of a sum of money by a person resident in India. So if there is any person, any non-resident who is residing outside India, if he receives the gift in the form of a sum of money by a resident in India, and if he is a non-relative, that will be considered as income deemed to accrue or arise in India. There are certain exceptions. Of course, these two exceptions already I have explained. When we talk about business connection in India, with respect to a non-resident, there is one exception which says reasonably attributable to operations in India. So when a non-resident has got a business connection in India, we cannot say that his entire global income is income deemed to accrue in India. So we have to see what is that is attributable to the operations in India. Say suppose a a person has got companies in more than 3 or 4 countries, including India, we cannot say just because he has got a business connection in India, his entire income will be taxed in India. So whatever reasonably attributable to operations in India, that one only we should take. Beyond that, it will be exempted. Purchase of goods in India for exports is exempted. Then news agencies are publishing newspapers, magazines or journals. If their main duty is to collect reviews and views and send it for publications, then that income will be exempted. Operations confined to shooting of any cinematography film in India. If there are non-residents, as an individual, a non-resident comes as a firm where all partners are non-residents, as a company where all shareholders are non-residents, they come to India for only shooting of any cinematography film in India, then whatever the income there is not considered as income deemed to accrue or arise in India. Then another exception is perquisites and allowances paid outside India is exempted under section 10, subsection 7. So this applies to this particular section or subsection 913, where I said salary payable by government for service outside India. So in case of an embassy, where there will be an ambassador or you have staff working there, any salary payment made by government of India to those people, that will be considered as income and are deemed to accrue or rise in India, and they will be subject to taxation in India. But apart from salary, there may be paid some perquisites and allowances for working outside India. That perquisites and allowances, even though that is considered as income as per 913, they have got exemption under section 10, subsection 7. So perquisites and allowances will be exempted. Salary will be charged to tax in India. So when to deduct, this also we have understood, credit or payment, which I is earlier. Exception, I said, interest payable by the government, public sector bank or public financial institution, where deduction is on payment basis, not on credit basis. Cooperative banks and foreign banks not covered under this. There can be 3 categories of payments to non-residents. Payment not liable to tax. So it will be exempted, not liable to tax. Maybe as per the Income Tax Act, it need not be liable to tax, or as per DTAA, it need not be liable to tax. Then payments taxable on gross basis. That is when we make payments towards interest, royalty, and fees for technical services. That is payments taxable on gross basis. Or there is a third category of payments where payments taxable on net basis, that is business income or capital gains. So when we talk about capital gains, now let me explain that 195(2), where the payer can apply for lower deduction of TDS, which is what is that circumstances when the payer can apply for lower deduction of TDS. So if the payer is making some payment to a non-resident, and if the payer feels that entire amount, that whatever the amount he pays, that entire proportion, entire amount is not his income in the hands of a non-resident, but only a portion of that amount is income in the hands of non-resident, then he can apply to the department saying that only this portion is an income. On that, I would like to do the TDS. To take an example, capital gains, if there is a transaction, if there is a sale of an immovable property where the owner is a non-resident and the buyer is a resident, then it attracts TDS under section 195. And on what amount that deduction has to be done? On the gross value, that is sale consideration. So if you are making a sale consideration, the non-resident is making a sale consideration to a non-resident. Sorry, if a resident is paying a sale consideration to a non-resident, on the entire amount, TDS has to be deducted. Now, if in the hands of non-resident, sale consideration is not his income, we know that out of sale consideration, you have to deduct the expenses incurred, then you will get the net sale consideration. From that, you have to deduct cost of acquisition and cost of improvement. And if it is a long term, you have to do the index cost of acquisition, index cost of improvement. The net will be the capital gains on which any person, whether resident or non-resident, he has to pay the tax. But while making the payment, TDS provisions is applicable on gross payment, that is entire sale consideration. So in those cases, the payer can apply or even payee can apply, stating that the entire amount is not income in his hands. So only on that portion, TDS can be deducted. Now, as a chartered accountant, can we determine the capital gains? We know all these things, like we know the sale consideration, we'll have a document. We know the purchase value also, we will have another document for that, the purchase deed, sale deed, everything. We know the indexation, we will calculate everything, and we will arrive at the capital gains, and we will say, this is the income of the non-resident. On this income, we will do the TDS. Whether as chartered accountants, we can do that calculation, and whether we can issue certificate in Form 15CB stating that this is the only income that has been out of this total proceeds. This is the income on which this is the tax, and this is what we are deducting the TDS. As chartered accountants, we cannot do that. The answer is no for that, because there are certain provisions where, as a payer or payee, they have to apply to the income tax department and get a certificate. As a chartered accountant, we cannot calculate the income, arrive at the income, and issue certificates on that. So we should be careful in these transactions as well, because client will say, sir, this is my sale proceeds, this is the purchase cost, you know, the capital gains is net. Why don't you issue certificate on this? Why don't we deduct TDS only on that? You should be categorically say that we cannot do that calculation. We have to apply to the income tax department and get a certificate for nil or lower deduction of TDS. Then section 2, subsection 37A, subclause 3, I said rates in force. This is what it says. Whichever is beneficial by virtue of the provisions of section 92, that is rates or rates in force as per the Finance Act, or the rates of income tax specified in DTA. Whichever is beneficial will be the rates in force. Then there is explanation 2 to section 195(1), where it says, see, certain incomes that in case of non-resident, there is no requirement that it should be in India, that services should be rendered in India, or it should have a place of operation in India, that you need not have a residence in India, you need not have place of business or business connection in India. Irrespective of that, whether he has got residence, business connection, or place of business, and whether he has got any type of presence in India or not, certain incomes, if it has been rendered outside India also, it will be considered as income deemed to accrue or rise in the hands of a non-resident. Then 195(2), I already explained, applicable only where there is any such sum chargeable and the payer considers that the whole of such sum would not be income chargeable. That example what I gave was capital gains. So if the payer feels that entire sale consideration is not income in the hands of the non-resident, then he can apply to the department and get a certificate for that particular portion of income that is subject to tax in the hands of non-resident. Then 195(3). So when 195(3) is a situation where the non-resident feels the entire income, means whatever entire sum that it has been received, is not income in his hands, so he can claim for a nil withholding certificate. He can apply for nil withholding certificate under section 195(3). Then 197 also says either nil or lower deduction of TDS a payee can apply. So section, if you have to see the comparison between 195(2), 3 and 7, this 195(2) and 3, whatever you get it, that's called as an order, and under 197 it is a certificate. So this will be an order issued under 195(2) and 195(3). Application made by the payer for 195(2), 195(3) and 197 by the payee. Circumstances, part of the income is chargeable to tax. Under 195(3), no income is chargeable to tax. That is, entire income is not chargeable to tax. 197, no deduction or deduction at lower rate. So whether it is appealable, 195(2) order, yes, it is appealable under section 248, but 195(3) order and 197 certificate is not subject to appeal. Then 195(4) talks about validity period of certificate. These are all the procedural things. I think I'll skip this. And 195(5) says application by payee for nil withholding certificate. Is it that every non-resident can apply under 195(3)? The answer is no. There are certain requirements. That is, he should be regularly assessed in India. He should have a fixed assets exceeding 50 lakhs. He should be carrying on business for more than 5 years. So he should have a presence. The non-resident should have a presence in India. Then only he will be allowed to apply under 195(3) for nil withholding of taxation. So for each and every non-resident, if he has started a business or if he has done some services in India, he cannot apply under 195(3). Then 195(6), where we are concerned, that is the payer shall furnish certain information in form 15CA and 15CB. 15CA is information to be uploaded, 15CB certificate from a chartered accountant, and 15CC statement from authorized dealer. That is, statement from authorized dealer means the bankers who are helping to remit this foreign currency outside India, then they can they have to prepare a quarterly statement in form 15CC and they have to file with the income tax department. Then there is something called a concept of grossing up of tax. Section 195(8) talks about income payable net of tax. So there may be a situation where a non-resident says, I am not worried about your tax rates or your tax compliances in your country. If I raise an invoice, say suppose an invoice is raised for 10,000 US dollars. If I raise an invoice for 10,000 US dollars, you pay me 10,000. Whatever the taxes, that is your headache or you have to take care. Then in those cases, it has to be grossed up. So let us take this example where you have got a invoice for 10,000 US dollars, and if you have to deduct TDS, the TDS rate is 10%. So you have to deduct 1,000 and you have to remit 9,000 US dollars. Now the non-resident says, I'm not, I don't want your tax. I want net, that is 10,000 US dollars. When I raise the invoice for 10,000, you pay me 10,000. So in those cases, the payer, that is deductor, has to bear that tax liability. How you will do? You have to gross up. So in the case I said, in this example, I said 10,000 is the payment, 10% is the TDS rate. So after deducting 1,000, you have to remit 9,000. So what you have to remit is 90%. Okay. Now for grossing up, you should take 10,000 US dollars as 90%. Then that has to be grossed up. So if you take 10,000 divided by 90%, you will get 11,111. On that, you have to calculate 10%, which comes to 1,111. The balance will be 10,000. So 10,000 you have to remit to the non-resident. 1,111 has to be remitted to government as tax liability. So this is what the concept of tax means, grossing up of tax will come. Then 40A1 disallowances I have already explained. 100% of the amount will be disallowed if the deductor has not deducted the TDS or deducted but not remitted. 206AA, that is obtaining of PAN. So if wherever that the PAN requirement is there, under section 206AA, we know it is to be charged at a higher rate, at the rate of rates in force or at the rate of 20%, whichever is higher. Then 206AA, the new section, non-resident having permanent establishment in India. So those non-residents who have got a permanent establishment in India, for them only this 206AB will be applicable. Otherwise, they will not be considered as specified persons. And if they are specified persons for not filing the return of income, it will be at the twice the rate of rates in force or at the rate of 5%, whichever is higher. Then I said these are some of the sections, other sections where you can come across this non-resident payments. I've just given the sections and the nature of payment, the rate of tax. So nothing much to explain here. It's only information that has been there. When I share the presentation, you can go through this. Then this also, the rates are how to calculate the rates. I've just taken from the Finance Act and some of the sections in the Income Tax Act. So this is for non-resident individual other than other non-residents and for a foreign company. And under section 111A, short-term capital is 15, the same in all the cases. And 112(1)(c) and 112A is also 10%. Then other long-term capital is at 20%. Then winnings from lotteries, that is casual income at 30%, dividend income 20%. Interest payable by government or Indian concern is 20%. Other income, in case of non-resident individuals and other non-residents, 30%. For foreign companies, it is 40%. Then the main thing, that is royalty and fees for technical services, it is 10% in all the cases. Any income from investment with respect to non-resident individual is 20%. Now, tax rates, like I said, 10%. If you income tax rate for royalty, FTS in section 158 is 10%, which we saw in the previous slide. When I add this surcharge and cess, surcharge is 5%, maximum surcharge, and cess is 4%. For 10%, if I add 5% surcharge, for that rate, if I add 4% cess, I'll get a rate of 10.92%. And DTA rate, it can be 10%, 15%, or 20%. 206 AA rate is 20%. Income tax rate for business income. So for business income, foreign companies, the rate of tax is 40%. On that 5% surcharge and cess, it comes to 43.68%. I've given a table where the comparisons are there. Because of paucity of time, I'll just skip this particular slide. So whenever you have a P in India, if it is say there's no P in India, it will be 10%, 10.92%, 20% or 20%. But if you have P in India, it will be considered as a business income. In all those situations, it will be 43.68%. So we have to analyze all these three things and then arrive at the rates. I think I'll leave it for you. Then we'll come to Form 15 CA and CB, where 37BB, Rule 37BB talks about furnishing of information for payments to non-residents. So Rule 37BB we have to go through, where which tells us, it gives the what are the procedures that has to be followed for furnishing information in Form 15 CA and 15 CB and also 15 CC as such. Rule 37BB has got 8 subsection sub-rules. 37BB 1 and 2 and 37BB 2 talks about information in Form 15 CA. So any person, the deductor making payment to a non-resident, he has to provide information in Form 15 CA. And there are 4 parts: Part A, Part B, Part C, and Part D. When Part A will be applicable, when Part B will be applicable, Part C will be applicable, and Part D applicable, we have to understand. So whenever a deductor is making payment to a non-resident, and during a particular year, if the payment is less than 5 lakhs to the non-resident, then Part A has to be used. So during the entire financial year, if the payment, if he feels that it is less than 5 lakhs to a particular non-resident, Part A has to be used. Then Part B and C, when the payment is more than 5 lakhs in the previous year, when a payment is more than 5 lakhs in the previous year, and there are certain situations where either the payer or payee has applied for a certificate under 195.2, 195.3 or 197. And if he has got a certificate for lower or nil deduction of TDS, then Part B has to be used. If certificate is not obtained, that is payer or payee has not applied for and he has not received the certificate, if the amount of payment is more than 5 lakhs in the previous year, Part C has to be obtained. So whenever it is Part C where certificate is not obtained, for that a certificate has to be issued by a practicing chartered accountant in Form 15 CB. So there, that's what I said. You are certifying, as chartered accountants, we are certifying the nature of payment and the rate of TDS. So when you are not applied for nil or lower deduction, the department has not given you the rate of TDS, then the chartered accountants have to give the nature of payment and the rate of TDS. So whenever Form 15 CA Part C is applicable, then Form 15 CB will be applicable. In other cases, Form 15 CB will not be applicable. Then information in Form 15 CA, that is in Part D, wherever the sum is not chargeable to tax under the Income Tax Act. So we know we should understand when a payment is made to non-resident, first thing you have to ascertain whether it is sum chargeable to tax or sum not chargeable to tax. If it is sum chargeable to tax, either of these parts will be used. If sum is not chargeable to tax in the hands of non-resident, Part D has to be used. When you use Part D, Form 15 CB is not required. Similarly, when you use Part A and Part B also, Form 15 CB is not required. Only for Part C transactions, 15 CB is required. Then remittance under LRS and specificities, that also I have already explained. LRS means a liberalized remittance scheme where a person can withdraw or can transfer up to $250,000 US. $250,000 US converted into Indian rupees, whatever the conversion rate. that much of amount in a particular financial year, a resident can remit outside India under the liberalized remittance scheme. And they have given a specified list. Specified list contains so many things. That is purchase of goods, importing of goods, or you're making some investments, or you're making certain travel expenditures, or for medical expenditures. So there are certain specified lists. Almost 33 lists are there. That also will be covered, for which 15 CA is not required. For both LRS and specified list, even Form 15 CA is not required because it is not paid to some other non-resident as such. For towards their own requirement, they'll be making the payment. Some of the specified list, even they'll be paying to the non-resident, that is with respect to purchase of goods, import of goods and all. But that is not some chargeable to tax under the Income Tax Act. So any of this Form 15CA is not required. Then 37 BP, it talks about Form 15CA, where the deductor has to remit Form 15CA electronically. There are two options, using one with DSC and without DSC. So both the forms should be submitted electronically, and while submitting to the bankers, either they can sign digitally using the DSC, or they can take a printout, sign physically, and they can give it to the bankers. Then 37 BB5 talks about 37 BB6. Let me tell you, certificate in Form 15 CB be furnished and verified electronically under DSC. So any certificate to be issued by a practicing chartered accountant, it has to be done through a valid DSC. Without DSC, you cannot issue a Form 15 CB. Now, these are all the types of Form 15 CB which I explained: Part A, Part B, Part C, and Part D. If you see all the three parts, the remittance type is chargeable to tax. So this is chargeable to tax in the hands of a non-resident. So whatever sum that has been paid by resident to non-resident, it's all chargeable to tax in his hands in India. Part D is a situation where the remittance is not chargeable to tax in the hands of non-resident. Then the limit, let us see, remittance during the financial year does not exceed 5 lakhs. Part A has to be used, and Form 15 CB is not required. Part B, remittance during the financial year exceeds 5 lakhs, and it is chargeable to tax, and certificate under any of these sections has been obtained. Form 15 CB is not required. Part C, chargeable to tax, remittance during the financial year exceeds 5 lakhs. Form 15 CB required, yes. So you have to give Form 15 CB for using Part C. Part D, not chargeable to tax, limit is not applicable. Form 15 CB is also not applicable. So limit is not applicable means whether it is less than 5 lakhs or more than 5 lakhs, even 50 lakhs, there is no limits. If it is not chargeable to tax, Part D has to be used. There is no need for Form 15 CB. Then these are all the, as I said, the specified list. Almost some 33 specified lists are there where we can go through this. Then 37 BC, relaxation from deduction of tax at higher rate under section 206 AA. I said for 206 AA, even a non-resident has to furnish his PAN number, but there are certain exceptions under Rule 37 BC, which says 206 AA is not applicable for payments to IRTDC. IRTDC means the payments with respect to interest, royalty, fees for technical service, dividends, and transfer of any capital asset. So if we are making payment to a non-resident towards these type of income, even if the non-resident has not provided you the PAN number, this section will not be applicable. Then this one, provided the non-resident has to give these information, that is to give his name, email ID, contact numbers. Then he has to give the address of the deductor of the country or specific territory of which he is a resident, and certificate of his residence. So the tax residency certificate has to be given. Then tax identification number or a unique number to identify his residential status. All this information he has to furnish. He need not furnish his PAN number. Then coming to the practical aspects, that is the new portal. As I said earlier in the beginning itself, the portal is not working, but somehow last week our office, they could file two Form 15 CB. So sometime it will work and sometime it will not work. So that's a problem. As of now, the portal is not fully what I should say is operational. So we are generating manual form 15 CP and we are signing and giving that to the department as such. Sorry, the bankers as such. Even 15 CA manually we will generate and both the things signed we are giving it to the bankers and they are remitting. So what are the procedures? What are the procedures? Let us see. When this portal becomes active and where you can keep generating form 15C and 15CB, this is the steps that you have to use it. So for steps of filing form 15CA online mode, log into IT portal, that is a remitter. The person who is making this payment, he has to, his portal you have to go. The dashboard, you go to the dashboard, e-file income tax forms and file income tax forms is there. Select form 15C and click on let's get started. So we have to get into this filing of income tax forms. This is the IT portal of a remitter. Select form 15C and let's get started. Select the applicable part. That is part A, part B or part D and fill in the details. So either of these part we have to select and fill in all the details. Verify the details in the preview page and click on proceed to e-verify. So there are various forms of e-verification for the remitter. E-verify the submission using DSC. It's not compulsory that DSC has to be used. There are 4 or 5 types of e-verification. You can do the e-verification and submit. And if you have a DSC, you can put it. Otherwise, it's not compulsory. On successful e-verification, transaction ID and appointment number will be displayed. Make a note of these numbers for future references. A confirmation message will be sent to the registered email ID and mobile number. So all these remitters, they have to keep they have to log in or key in their registered email ID and also the mobile number. So you will get whatever if after completion of this, you will get a message to the registered email ID and maybe even a message to your mobile number. So this is a situation where we are filing form 15CA part A, B and D. For part A, B and D, I said form 15CB is not required. So in this is the process for filing 15CA, either part A, part B or part D. These are the process. Now, we will look into the process, steps for filing form 15CA, part C and form 15CB online mode. Now log into IT portal, the remitter portal, and these 2 steps are same. Select form 15CA and click on let's get started. Select the applicable part C. That is, in this case, we are selecting part C. Click on assign CA to allocate the form 15CB to a particular CA from the list of CAs. So whenever this remitter enters into IT portal, you may have various auditors. Like you may have a chartered accountant for his statutory audit. You may have a chartered accountant for his GST audits, GST work, or transfer pricing, or something else. So like tax audit, you may have one chartered accountant. For statutory audit of a company, you may have one chartered accountant. And even for issuing this, what do you call this, form 15C base, you may have 2 or 3 chartered accountants. Depending upon who is available, he may be assigning that CA. So the remitter has to click on assign CA and he has to pick the person, the chartered accountant who is issuing form 15CB, and he has to assign. Fill all the relevant information with attachments and click on submit to CA. So he has to fill all the relevant information, whatever information he has got, and they have got some certain, what you say, you can even do some attachments. Like the remitter can fill up all these details. He can fill the relevant information with attachments and click on submit to CA. What are the attachments? Maybe he can attach like the invoice, or he can attach an agreement. He can attach, I think, no PA declarations. Whatever that can be attached, I think maximum 5 or 6 documents you can attach, and the size of total document should be less than 50 MB, and the size of each document should be less than 10 MB or something like that is there. So you can attach all those things and submit to CA. On successful submission, transaction ID will be displayed. Make a note of these numbers for future reference. So first step is remitter will do all these things and submit to CA. The next, the chartered accountant has to log in his IT portal. So to whichever chartered accountant he has assigned, so he has to get into his portal and he has to go to his dashboard, work list, pending actions, for your action. from the list, select the Form 15 CB and click on accept. So the chartered accountant, when once it has been assigned to him, he has to click on accept. A success message will appear. When once he says accept, a success message will appear. Again, go back to work list. Again, go back to work list. Then from the list, select the Form 15 CB and click on file form. So again, you have to go back to the work list after you accept that particular this thing. Then you open Form 15 CB and click on file form. It's not just like that. You click on file form and you will file. So you can even edit. Select the mode as online and click on continue. Details filed by the remitter will appear in 4 categories. So whatever that information that has been filed by the remitter, whatever information he has got, he will, as I said, he will upload that. So it will appear in 4 categories. So the 4 categories means he may give the details of the remitter. He will give the details of the remittee. He will give the tax calculation as per the Income Tax Act. He would have given the tax calculation as per the DTAA. So some other information, we know what are the contents of Form 15 CB, all those things he will give. Review the details and click on verify. So you may have to review all those details. You have to click as verify, click on preview and proceed to e-verify. E-verify the submission using DSC. Here compulsory DSC has to be done. On successful e-verification, transaction ID and acknowledgement number will be displayed. Make a note of these numbers for future reference. Now, 15 CB is done. Now, whether this is final? No. Again, once the CA has filed the Form 15 CB, log into IT portal remitter. So remitter again has to log into his IT portal. He has to go to the work list for his action. He has to select accept or reject next to Form 15 CB uploaded by the CA. So when once the chartered accountant has uploaded Form 15 CB, it is not final. The remitter has to go there and he has to either accept Form 15 CB or reject Form 15 CB. He has got option to both accept and reject Form 15 CB. For rejection, he has to provide the reason, and for acceptance, for accepting, enter the remaining details in Form 15 CA. When once he accepts, there may be certain information which he needs to fill in Form 15 CA, or if he has already filled in, there is no need for him to fill again. So verify the details in preview page and click on proceed to e-verify. So the remitter can e-verify the submission using with or without DSC. That's what I said. So e-verify the submission using DSC, it says, but I think even without DSC, you can do it as per the rules. But as per the new portal, it says using DSC, that we have to see practically how it works. So e-verify is, as I said, 4 or 5 methods of e-verification is there, which need not be using DSC. DSC is one of the methods of e-verification. So e-verification can be done. When on successful e-verification, you will get the transaction ID, acknowledgement number. The same will be sent to your registered email ID and mobile number. So this will complete the process of filing Form 15 CA and 15 CB. So this is offline, that is online what we are talking. So there is some offline version that has been released, where as of now, we are using this, we are downloading, and offline we are doing and submitting to the bankers. So some of the common fields in Form 15 CA and CB, name and address of the remitter has to be given, and name and address of the beneficiary of the remittance, contact information, residential status of the remitter, then PAN if available, details of remittance, details of TDS, verification of the form. So all these things are some of the common fields which we find both in Form 15 CA and 15 CB. So I think now it's already 6:10. I will just skip this issues and probable solutions. So finally, I thank you for all of you for giving me this patient listening for last 1.5, almost 2 hours. If there are any questions, let me take it. Thank you once again, Bangalore branch, for giving this opportunity. Hello. Hello.
sir.
Yeah. Hello. Divya is there?
Madam is there, sir.
Madam is there.
So we can read out questions, sir.
Yeah. Yeah. Aishwarya.
So there's a question from Mr. Ashok. Health and education cess can be deducted for DTA rates or not?
Deducted.
Huh. Health and education cess can be deducted for DTA rates or not?
Added or deducted?
You're asking whether it can be deducted. Maybe the
No,
question is not
deducted.
clear.
No, it cannot be deducted.
Okay.
The DTA rate actually is the final.
Okay.
Wait.
Next question. Next question, sir.
Yeah.
It is TDS paid in excess can be adjusted in the earlier year or next year. Can you clarify under what situation we can envisage excess payments? How will these be reported in Form 27Q if adjusted against earlier, the previous year or subsequent year liability?
Where if you have excess.
Yes, sir. You
That
can
can be
go to
adjusted.
question and answer. Sir, can you?
Hello.
Yes, sir. Tell me, sir.
See, even in resident. Some echoes. Suraj. Hello.
Yes, sir, please speak, sir. Now.
Yeah, now it's okay. See, even in for resident TDS payment, there are certain provisions where it says if there is excess TDS, you can either adjust in the previous year or next year if there is a liability as such. So even in international taxation, say suppose there is a contract, you have made a TDS, and subsequently the contract is cancelled, then there is no liability for that TDS. If you have any excess TDS as such, then that can be adjusted in the if it is required for the previous year or next future quarters. Hello.
Okay, sir. Next question, sir. Income received in India, business profit taxable under Income Tax Act, not taxable considering DTA as no PE is 15 CA, 15 CB required. If yes, which part of Form 15 CA can be selected, Part C or Part D as per income tax? It is taxable but not taxable as per DTA.
See, then once it is not taxable, any amount which is not taxable, then you have to use Part D of 15 CA. If the sum is not chargeable to tax in India, then Part D of 15 CA has to be used.
Okay, sir. Next question, sir.
Yeah.
Is grossing up mandatory if the payer is willing to absorb the tax burden?
Payer is filling it. Hello.
Is grossing up mandatory?
Yeah, no.
if
Again,
payer
that
is...
echo is coming.
I will mute, sir, after reading question.
Yeah, please.
Then echo will not come. Is grossing up mandatory if the payer is willing to absorb the tax burden?
Yes. If the payer is willing to absorb the tax burden, he has to do that TDS because the government has to get the appropriate TDS. So that has to be grossed up and we have to make the payment. So you cannot, like in the example what I said, the 10,000 US dollars, we cannot say I will pay 1,000 rupees to government, 1,000 US dollars to government, and I'll remit 10,000 US dollars to the non-resident. The total will be 10,000 plus 1,000. That will not be correct. So we have to gross up for 11,101, where 1,101 you have to pay as tax to the government, and 10,000 you have to pay to the non-resident. Yeah, I've answered that question.
Only these many questions, sir.
Okay. Okay. In chat, anything is there? Everything in.
Now one question has come, sir. Now, if any resident is paying professional fee to non-resident, but for that NR it is business income, then resident has to withhold tax under article business profit or article technical or professional fee.
You will mute yourself.
Yes, sir.
See that professional fees, there is one more article, fees for independent personal services. We have to see that. And if they don't have a fixed base of business in India, that is profession set up in India, that will not be charged to tax. So there is no need for deducting TDS.
Okay, sir. One more question.
Somebody has raised hand.
Yes. What documents are required for claiming benefits under MFN status?
MFN status.
MFN status.
No, you mute yourself.
Yes, sir.
MFN means most favored nation clause. That there's no document that is required. I have to get into the DTA, the protocols you have to see. If there are certain protocols which says that subsequent to the entering of that DTA, if there is another DTA that has been entered between India and that country, and whatever the reliefs or things that is applicable to that country also will be applicable to this country. Those things you have to see through the protocols of each and every DTA.
Okay, so next question. Can you explain MFM clause?
That's what I explained. No?
Another question, same question. That's all, sir. Only these many.
Okay. In chat box, there are certain things, whether you want me to take it or. Hello.
You can access that and you can take up, sir.
In chat box, essentially we consider TDS. Whether the rate as on date of deduction or last date of previous month. Wahab Sharif has posted this. Wahab, I think we have to get into that rule 115. I don't have rule 115. I don't remember for each type of income. Certain types of income, they will give the dates. Like for a salary, they will say at the last date of the previous month. So you see what is the nature of payments, income, and see rule 115 and take that particular exchange rate. Bhamini has asked for Form 15 CA. For corporates, DSC is compulsory, sir. No, it's not compulsory. For Form 15 CA, we have an option. In 37 Rule 37 BB, if you see, there's an option for 15 CA. Either it can be submitted with DSC and without DSC. But when it comes to new IT portal, we have to see whether DSC is compulsory. Otherwise, for 15 CA, DSC is not compulsory. For 15 CB, DSC is compulsory. If surcharge and cess is applicable on payments, please explain with example of tax rate will in such cases. So from Pani Kumar, he says like surcharge and cess is applicable. So when I took an example, like say suppose you are making a payment towards royalties or fees for technical services. The rate is 10%. TDS rate is 10%. Now, assume that you are making payment to non-resident from USA, United States of America. If you see the DTA rate will be 15%. Now, income tax rate is 10%. I said for income tax rate, you have to add surcharge and cess. So I have given in the table, if you add surcharge and cess, it comes to 10.92%. So now I have to compare 10.92% with 15%, that is USA rate. Now, because 10.92% is less, I will apply 10.92% and deduct the TDS. Now, the same example, instead of the non-resident from Singapore, that is USA, let us assume he is from Singapore. For Singapore, India-Singapore DTA, the tax rate is 10% for royalty or fees for technical services. Now, as per the income tax rate, I'll calculate 10.92. That is 10% plus surcharge plus cess. And I'll compare with the DTA rate of 10%. Whichever is less or beneficial, I will deduct TDS at 10% in case of transactions with Singapore at 10%. In case of transactions with USA, I'll be deducting at 10.92%. In case of payee status, how to identify the residential status if transaction happens in mid of a year? Let's suppose in May. Shall we consider the last year residential status of the payee? Yes, you have to consider the last year's status, and on the date of transaction, you have to deduct. You have to decide whether a person is a resident or non-resident. In case of section 271C, deductor don't deduct TDS but paid TDS from his own pocket, will still penalty under section 271C trigger? Please answer from both resident and non-resident deductee scenario. No. 271 says if 271C penalty comes if deductor has not deducted and remitted. So if he is on his own, if he is paying also, it is nothing but the TDS provisions has been complied with. Then penalty under section 271. TDS certificate, whether the due date for certificates or the date for downloading the certificate from the traces or the date when these certificates are actually being distributed to the deductee. So that due dates is to issue certificates to the payee. So the due date says the certificate has to be issued to the payee, not downloading. So after you file the returns, that is TDS returns, within a matter of 3-4 days, you can download from traces. So you don't require 15 days to download from the traces. As soon as you download from the traces, you have the list of payees. Now, even through emails, you can immediately send it to all the payees as such. So it's the certificates has to be issued to the payee within 15 days, not downloading of certificates from the traces. In case of TDS certificate, whether the due date for certificate, okay. Can fee for technical be considered as business income? The fees for technical services can be considered as business income under two situations. That is one, where there is a make available clause in that particular DTA, and it says if that particular technical services is not made available to the recipient, then it will be considered as a business profit. So that is one situation. Second situation, there are certain DTAs where they won't discuss about technical service. There is no article for technical services. If there is no article for technical services, then it will be considered as a business profit. And accordingly, the chargeability will apply. Whether if they have a PE, if they don't have a PE, accordingly the taxes will be applicable. In case of 15 CACB, how to comply in case foreign payments via credit card, who will be the authorized dealer bank in such case, and what to do for cases of auto debit where even amount varies based on some consumption of services not known earlier. This is a practical problem for all credit card payment or auto debits. We don't have a solution as of now. It's really a practical problem to deduct TDS on these cases. Are banks bound to obtain 15 CACB in case of foreign payment? In case yes, how banks can apply for credit card? Okay. This I said it's a really what do you call this, a practical problem. I don't think bankers are insisting on 15 CACB for credit card payments. So it will go as it is. But when once you, what do you call this, you record that in your books of accounts, then if it is in the nature of payment where it is subject to TDS, but you have not done the TDS, then there is a chances that the expenditure will be disallowed. Is there any case law where department has reached penalty under section 271? Can you please share it for our reference? As of now, I don't have any case law for this. If I come across this, I will definitely share with you. Is Form 15 CACB filing is a borrowing provision from RBI? Filling is a borrowing provision from RBI rule or the independent one. Is there any mandate provision from RBI to collect Form 15 CACB by banks? Yes. This is as per the regulations and as per the Income Tax Act, RBI would have given a checklist for all the bankers to collect certain documents. RBI will say, and even the bankers, the head office of the bank, they decide what all the documents that they have to collect for remitting any funds outside India. In that, this Form 15 CA CB is also part of that documents. Thank you very much, sir, for a wonderful session. What is the purpose code for transfer from NRO to NRE account, sir? NRO, okay. Sir, this Vivek has asked one question. What is the purpose code for transfer from NRO to NRE account? So this, I don't know exactly the thing because I have to ask for the, I have to see, I have to go through that the codes. Basically what happens, this transfer of money from NRO to NRE account or from your Indian bank account to a foreign bank account, it is considered as repatriation of funds. So when you go for that purpose code, you see, you search for repatriation. If you're not getting, you just give me a call. I will search and I'll give it to you. Oh, is that okay, Vivek? Divya, I think I've covered all the questions, both in the chat box.
Yes, sir.
Chat box that has been asked. Over to you, Divya.
Yes, sir.
Divya?
I'm there, sir. I'm there, sir. So we can close the session, sir, or anything else you have to say?
So you're muted. You have to unmute, I think.
Unmuted, sir. Can you hear me?
Chill silent.
It is unmuted, sir.
Okay.
Okay. So members, I take this opportunity on behalf of Bangalore branch to propose formal vote of thanks for today's program. Wholehearted thanks to Cotha S Srinivas sir for sparing his valuable time and giving an excellent presentation. Thank you so much, sir, on behalf of all the participants and also on behalf of entire managing committee members. Thank you also, sir.
One Rashmi
Yeah.
has raised our hand.
Yes, sir, please.
Yeah, she has to ask some questions. She can ask, otherwise we can wind up. Rashmi has raised her hand. I don't know for what.
Sir, there is one question. Let me read out. Sir, if deductor an individual has failed to file the Form 27Q after deducting TDS from an NRI, how can NRI claim while filing the return? Individual is refusing to file now. What are the options does NRI has?
No, that's what I was explaining, the stages of TDS. The last two stages is with respect to the deductive. So it's difficult for NRI to claim that TDS credit because he has neither filed the returns nor what you say that issued the certificate for him. Practically, it is very difficult to claim that TDS. He has to get that TDS certificate.
So,
Can wind up.
Yes, sir. Okay, dear members, I take this opportunity to propose formal vote of thanks for today's program. On behalf of all of you and also on behalf of entire managing committee members, thank you so much, Cotha S Srinivas, for sparing your valuable time, giving an excellent presentation. Thank you so much for clarifying all our doubts also. Thank you so much, sir, once again.
Thank you, ma'am. Thank you all.
Thank you, sir. Thank you so much, all the participants, for active participation. Request you to kindly look into Bangalore Branch website for next program. Thank you, sir.
Okay.
Thank you, sir. Bye.